Okay, good afternoon, everyone. We'll go ahead and get started. Thank you for joining today's earnings release update for Hela Power Holdings, covering our fourth quarter results. My name is Adam Collins, General Manager of Corporate Affairs and Investor Relations for Hela. I'm also joined by our Group CEO, Mr. Don Kajinadasa, who's joining virtually today. And in the room with me, I have our Group CFO, Mr. Juan Fernando, as well as Savinia Tessera and Christine Jesudason from our corporate finance team. To outline the agenda for today's call, we will start with a brief presentation of around 50 minutes, focusing on the latest financial results, which were published yesterday. We will then move on to a Q&A for the remainder of the session. Questions can be shared through the Q&A box on your screen, and we would encourage you to send these in as we go through the call. You will also be able to raise your hand at the end during the Q&A session at the end of the call, and we will be able to unmute you. We will also be sharing the presentation by email following this call as well. Before we jump into it, a quick disclaimer on forward-looking statements. Any such statements are based upon the management's current reasonable expectations and assumptions and are subject to known and unknown risks. Given the risks and uncertainties that may cause the company's actual performance to materially differ from that expected or implied by these statements, we advise you not to place sole reliance on them. We also do not undertake any obligation to update these statements to reflect future events or circumstances that may arise. So with that, we'll move on to the main body of the presentation. So this first slide is a snapshot of the fourth quarter's results. While this shows a relatively positive picture, the underlying story is a bit more complex, and the year-on-year comparison in particular is somewhat skewed by the rupee depreciation, as well as some one-off factors that were present in Q4 of last year. So I'd say that the key takeaway for the fourth quarter is that the challenging operating environment continued, but there were tentative signs of improvement in both top and bottom line performance. So while revenue increased by 41% year-on-year to 20.5 billion rupees in Q4, this was once again primarily reflecting the exchange rate depreciation during that comparison period. In US dollar terms, which reflects the underlying performance of our export sales, revenue decreased by 9.6%. However, importantly, this is significantly less than the 20% year-on-year decline in revenue in US dollar revenue we saw in the previous quarter, so in Q3, as we have seen somewhat more resilient consumer demand than expected in the fourth quarter. Another factor at play is that some of the peaks in inventory levels among major apparel brands that we saw in Q3 have moderated to some extent, which has also supported some of that stabilization in demand. So based on that tentative stabilization in demand, as well as some of the proactive cost control and capacity management measures that we took in Q3, we have also seen some improvement in profit margins, particularly on a quarter-on-quarter basis. So while you're seeing that gross margins are down year-on-year here, compared to Q3, there has been about a 350 basis point improvement up to 13.5%, as capacity utilization rates across our manufacturing facilities have improved. Prudent management of distribution and administration costs has also helped to support our return to operating profit. So crucially, this 911 million rupee operating profit is compared to a 430 million rupee loss in Q3. So there has been a significant improvement there. Nonetheless, the improvements that we have seen in profit margins haven't been quite sufficient to drive that return to a positive PAT. And that's primarily because of the rise in finance costs due to elevated US dollar interest rates, and also the one-off deferred tax charge arising from the increase in Sri Lanka's corporate tax rates during the year. And so both of those remain significant drags in profitability and contributed to the 257 million rupee loss you see here. Though we should say that this was substantially less than the 1.7 billion rupee loss recorded in Q3, but of course it's still not where we would like it to be. One final positive to draw your attention to is that despite a challenging year, our balance sheet does remain in a fairly resilient position, and we've seen further reductions in our net debt to equity ratio to 1.6 at the end of March compared to 1.8 in the previous year. And this has been supported by some improvements in our working capital cycle. Moving on to the next slide, I won't dwell too much on this because it really just covers the factors which I just discussed for the quarterly performance. However, I will dwell slightly on the chart on the right-hand side, which we have shown for the past number of quarters. So the inside ring showing the split in revenue by country of manufacture in Q4 of the previous financial year, so FY22, versus the split in revenue for the most recent quarter just completed. So while it looks like there's been a fairly significant reduction in the share coming from Sri Lanka, kind of at the gain of Kenya, this is somewhat distorted by some one-off disruptions that we saw in Kenya last Q4. So actually, I would say that the 40-40 split between Sri Lanka and Kenya is in line with what we saw in Q3 and kind of earlier in the year. So the only real additional factor that's come in here is the growth of Egypt shown in yellow there, which has gone up to about 12% of revenue. And so we think this revenue split is something that we would expect to see kind of continue into the current financial year, into FY24 as well. Taking a step back to look at the quarterly performance in more context, this slide shows quarterly revenue for the past 3 years on the left and operating profit on the right. So on the revenue side, abstracting from the impact of the rupee depreciation, which is driving that kind of step gain from FY22 into FY23, it's clear that we've seen a marked cooling in demand conditions in the second half of the year, which is contributing to that drop you see there. Though I should say that particularly in Q4, we do normally see a minor seasonal drop in Q4 compared to Q3, which is also at play there as well. In terms of operating profit, you can see that very significant swing back from an operating loss into an operating profit in Q4. It's also worth pointing out that from an operating profit perspective, this was the strongest Q4 outturn for the past 3 years. Though it is still below where we would like it to be, and obviously below what we were achieving in the first half of the financial year as well. So to kind of go into more detail on one of the key factors driving particularly that operating profit improvement, this slide goes into more detail on distribution costs. So the chart on the right-hand side shows distribution costs for each quarter of FY23, with a light blue portion showing the contribution from unplanned air freight. And this is where we've had to cover the cost of air freight to the customer to ensure that the goods are delivered on time, rather than shipping by sea as we would normally do. It's just a significant additional cost for the company. So as you can see, this was a significant driver of the relatively elevated distribution costs for much of the financial year, particularly in the first half. Crucially, however, there has been an over 90% reduction in this cost since it peaked in Q3, from over 2.5 million to just over $180,000. And so this has really been driven by some of the earlier disruptions that we had coming out of Kenya. There was knock-on impact, which were driving that air freight in the first half of the year. Those impacts have faded, as well as some process improvements we've made to make sure that we don't need to air freight those goods. What you see is a very substantial reduction on this, and that's really helping to support the operating profit margin in Q4. And going forward, we would expect to see that continue into FY24 and kind of contributing to the normalization of distribution costs during the year. So to give some context to that, between FY19 and FY22, in that 4-year period, distribution costs averaged about 2.1% of revenue. Whereas in FY23, the financial year just completed, it was 4.7% of revenue. So there is substantial scope for distribution costs to be more tightly managed and support profitability in the current financial year as well. Taking one additional step back, I'd like to also touch briefly on the full year performance. So this chart shows the half-year performance over the past 3 years, with the bars showing US dollar revenue to abstract from the exchange rate impacts, which are shown in the rupee figures. And then the lines are showing gross and EBIT margin. So the reason we've opted to show the half-year performance in this chart is because the deterioration in market conditions in the second half of the year has really been a key influence over the full year performance. So focusing on the bars, what you can see on the right-hand side is that while we saw continued revenue growth in dollar terms in the first half of the year, that significant slowdown has really come in the second half. And that is really what has undermined the profit margins in the full year as well, as you see that drop in both gross and EBIT margin. So as a result, while overall USD revenue for the full year FY23 was more or less unchanged, it was down about 0.5%. That significant deterioration in market conditions in H2 has significantly eroded the accumulated profits in the first half of the year and contributed to the full year loss that we've seen. Yeah. One additional slide before we move on to the outlook, as a kind of additional milestone that we had during the quarter, is the financing deal announced with NORFUND, the Norwegian government's development finance institution. So this is a $14 million long-term debt facility, which will be focused on supporting Hela's African operations. I've highlighted some of the key focus areas here. So part of it will go towards capital expenditure for the Kenyan manufacturing facility, which will support increases in efficiency and help to reduce machine rental costs there, so improving the overall profitability of that operation. In addition, the remainder of it will go towards supporting Hela's strategic supply chain partnerships in Africa. So that will help us to develop additional capacity in textiles and other components in the region, thereby providing cost and lead time benefits to us compared to when we have to source from Asia. We do also feel that NORFUND is an important potential partner as we look towards a potential supply chain investment in Africa in the medium term as market conditions stabilize as well. Moving on to the outlook for the coming quarters, what we are seeing is that the challenging operating environment that we've experienced over the past number of months is likely to continue into the first half of FY24. While consumer spending has proved more resilient than many expected so far, there is a lot of uncertainty about whether this will be sustained, particularly in an environment where inflation remains elevated and there continue to be expectations that major central banks will hike interest rates further to ensure that those price pressures are brought down. And so that's why I've also highlighted these kind of key risk factors on this slide. In addition, given the sort of fragile position of the global economy and in our key markets as well, the kind of potential shocks that we've seen come up are also something that could easily knock us off progress. So while we've seen today that it looks like we'll avoid a US government default, concerns over financial stability in the US are also there. So those are kind of key things that we're watching out for as well. So in this context, we will be very much seeking to remain agile to the evolving operating environment to ensure that we are managing cost and capacity appropriately and driving a return to profitability. We do also feel that our diverse customer base should be an asset. It covers, and it's strategically chosen to cover, a mix of luxury brands as well as more cost competitive brands, including supermarkets, and also a range of product categories that are more or less considered essential or relatively resilient to shifts in economic conditions. So we do feel that is a positive factor as we kind of move through this period of uncertainty as well. Before we close and move to the Q&A, we also wanted to give you kind of an additional sense of the key focus areas that we have for the current financial year. So of course, the central focus will be on driving profitability and as well as focusing on financial results. We'll also be focusing on a number of initiatives around this. So one will be kind of focusing on continuing to focus on proactively managing our capacity to align with the evolution of demand. We feel that we're relatively well positioned for this, as well as at the same time, ensuring that we are very proactively going out for business and also deepening those strategic customer relationships to ensure that kind of regardless of the economic shifts that we are a key vendor for our key customers as well. And then within the business, we'll be looking at things like including the completion of the SAP rollout, which will kind of help us to increase that agility to quickly respond to evolving market conditions, as well as introducing and continuing to work on a number of process improvements to ensure we are always optimizing our operating costs as well. And then finally, as we kind of alluded to on the NORFUND slide as well, we will also be kind of focusing on our continued drive for supply chain regionalization, particularly in Africa, which helps us to also reduce costs in that area. And then finally, the diversification of financing lines. So NORFUND is the first part of that, but there will be further financing transactions that will be coming into play in the coming quarters. That will be helping us to kind of diversify away from some of the Sri Lankan banks that we've been working with, and kind of helping us to take out that risk premium we've seen in some of the interest rates in Sri Lanka as well. So that will also be helping as well. So that is all the slides that we have for today. We will be sending this deck out. We have a couple of additional slides on our social capital initiatives, which we would encourage you to go through. But otherwise, we would be happy to open the floor to questions. So if you could feel free to insert any questions you have in the Q&A box, or feel free to raise your hand and we will unmute you. So we'll give a few minutes for people to send in questions. Yeah, feel free to also raise your hand. So one question we have is on volume growth rates on a quarter-on-quarter and a year-on-year basis. I think I'll maybe jump in and take that, if it's okay. I would say it's not dissimilar to the USD revenue numbers that we've seen. So and we would measure it in terms of standard hours rather than number of pieces per se, in terms of our output, but it is about 10% down year on year, but a little bit up Q on Q. So we had a few more questions come in as well. So let's just jump into them. What is your anticipation on the upturn in global demand for apparel? JTLOOK, if I could hand that one to you.
Thanks, Adam. It's really hard to say. I think one thing we can claim as an industry is that post-September, there seems to be a pickup. But then again, whether we have sufficient indications to say that this is a market recovery, I mean, it's too soon to say that it's a sign of a market recovery. So there is an upside that we're seeing, but of course it's coming with some severe margin pressure at the same time, purely because this sort of a depressed demand environment is not for Sri Lanka alone. Most apparel countries are experiencing it, from the Far East to the Indian subcontinent. So with everyone trying to fulfill their open capacity, they are using price as a leverage. So yes, there is a demand uptick that's coming our way, but that's coming at a very severe price competition.
Thanks, JTLOOK. Next question is on the exchange rate. So since the reporting date, have you made significant reductions in liabilities due to the change in the exchange rate? So I assume you're asking about the impact of the rupee appreciation. So I'll let our CFO, Yuan, take that one.
Yeah. So yes, rupee appreciation has an impact, but in terms of the change in liability in USD terms, we haven't seen a significant reduction because our sale for Q4 and Q1 is basically remains the same. So we will have to, I mean, bring inputs for production. So dollar to dollar, we haven't seen a significant reduction in our liabilities for suppliers. But yes, due to the change in exchange rate in LKR terms, yes, we have.
I think if I could add to that one, since it's related, this question on the explanation for the 693 million rupee other gain in the quarterly accounts.
Yes, so the gain is basically on the exchange in terms of forward booking. We have made significant gains by forward bookings that we have made. So that's the biggest reason for exchange, gains and gains in Q3. And we will be, I mean, we are watching the market, and we will be basically trying to hedge as much as possible given the rupees appreciating drastically. So to answer the question, the gain is because of the realized and unrealized gains that we have had from our forward contracts.
Thank you, Ruhan. I'm going to group a couple of questions on the demand side for you, JTLOOK. So one is, what do you see as the level of overstocking by major retailers at present? And also, have there been any order cancellations?
There hasn't been any order cancellations. I mean, if at all, there's been some requests for pushbacks. The brands are asking to delay the deliveries, but I think we're at the tail end of that period. It's hard to say how many weeks of inventory are the brands sitting on, but what we're seeing is that it is coming, I think by about August, it is getting to a level that the brands are comfortable with. And each brand is experiencing, is facing this downturn in different ways. I think what we can see is that retailers tend to be doing a little bit better than the wholesalers, because many brands are using the wholesale channels to get rid of a lot of their inventory. So the wholesalers are packed up. And we are starting to see certain channels do better than the others as well. So right now, what we're trying to do is to really go after more retailers, because of their shorter lead times, and capitalize on the upside better by going through that channel than with the wholesalers.
Thanks, JTLOOK. A couple of additional questions on the finance side, one of which is the reason behind the significant increase in net finance cost, and also what explains the large gain in the revaluation of land and buildings.
Yeah, so I'll touch on the second one first. We have valued 2 of our properties in Mavatagam and Naramala. So that is the reason for the significant gain that you see in terms of revaluation in our financials. With regard to the finance cost, it's purely, purely from rate increase, which is actually linked to LIBOR. LIBOR has, if I just give you the rough rates, yeah. So just a moment. Yeah, so LIBOR has moved from 1 to 5.2% during last financial year. So there's a corresponding increase in our weighted average cost of debt, which has moved from 5.2 to 11. Which is actually the reason for the significant increase that you see in the finance costs.
Thank you, Ruhan. I think there's a few questions on expected capacity or factory utilization in the coming quarters. I think, so in terms, there's also a question on how that might be split across countries. So I'll just make a few comments, and then JTLOOK or Rowan, feel free to add. I think we are seeing sort of a kind of continuation of the demand level that we're at now in the first quarter or thereabouts, but it is quite highly uncertain. So it will be an important aspect of us will be kind of managing our capacity to try and match demand as it evolves, which is something we can kind of do when it's primarily labor driven as well. Just a few final questions we can take. So one, which just to reiterate, which we may have covered. So one is that despite Hela reporting a loss in Q4, other textile players have reported a profit, considering that apparel is closer to the customer than textile. One would expect Hela to have a greater bargaining power in the market. What are your thoughts on this? Maybe JTLOOK, I'll let you take that one.
Sure. I mean, it comes down to the level of fixed costs that you have. When you do have underutilized capacity, the contribution margin might not be sufficient to cover some of that fixed cost. Like Adam mentioned at the start, we've seen an improvement from the third quarter going into the fourth quarter, and we're continuing to try and reduce our fixed costs further, either by cost control measures or special initiatives. So that's where SAP plays a big role, because for the first time, as of 1st April, the whole group is on one platform. So any resources that were duplicated can now be rationalized. And there's many other initiatives. We did a factory consolidation phase in Sri Lanka as well a few months ago, and we'll continue to explore other opportunities to rationalize that cost base. So I think that's one of the reasons why there's been a difference in performances. But what we are trying to do is, okay, how do we recover fast, even in a depressed demand environment?
Thanks, JTLOOK. So one additional question we have is, can we explain the regional and geographical wise contribution for top line? So that was the earlier pie chart I showed. So it's about 40% manufacturing in Sri Lanka and 60% manufacturing in Africa is the revenue generation split. Within the 60% coming out of Africa, it is about 40% from Kenya, and then the balance split between Egypt and Ethiopia.
Exchange.
Yeah, can you take
Yeah.
one final question on the exchange rate? So what are the measures taken to mitigate the unexpected exchange rate?
Yeah. So as I explained earlier, I mean, we have hedged our exposure up to July of this financial year, and we are watching the market, and then we are actually looking at hedging further, because that's the only way that we can hedge against our local overheads that we have to make. The rest of it, the dollar debtors and creditors there's a natural hedge, because we have revenue in USD and we pay in USD as well. So we are actively looking at hedging our exposure in the months to come.
Okay, perfect. I think we will bring it to a close there. We've covered a number of areas. Apologies if we haven't been able to get to your question, but do feel free to drop us an email. We will get back to you on any questions that are remaining. As we mentioned, we'll be sending out the presentation deck after today's call. And with that, thank you very much for joining today's call, and I wish you guys a good rest of your day.